Hello investors, welcome to Finance VCR. Perhaps on a hot topic today, vaccines are very much in the news, healthcare at the forefront of the minds of many. I thought, what better stocks to look at and compare than Pfizer and AstraZeneca stock? And the ticker symbols for I'm looking at today is PFEAZN. And if you do want to buy any of the stocks that I mention in the show, or indeed any others, I'll leave a couple of links below for you where you could get some benefits. For those in the UK, potentially a free stock worth up to £200 using my free trade referral link. And for those of you internationally, Interactive Brokers gives a very wide range of market access, including to pink sheets and over the counter, and I found them very useful for those rare investments in that area. Our usual disclaimer, I'm not a registered financial advisor, so do your own research before taking action. And just briefly, to help those of you that are newer to investing, I'd like to refer you to my Conditions for Success video. That show just goes over the key things you probably need before you start investing. And this video today touches on that stock qualification, looking at the balance sheet, the creation of a value for the company, and then a buy decision, looking at that with the market price and margin of safety. And finally, before we begin, big shout out to my VIP patron supporting the channel via the Patreon site. I'll leave a link down below if you'd like to join as well. I'd be very grateful. Key thing is, if you do join on the VIP level, you get direct access to me, you get to see my investment wish list, and we can talk about anything to do with investing for as long as you want. So we get some ideas bouncing around there. So let's crack on with the show. Start off with AstraZeneca, and you can see a very consistent, stable revenue. So no growth really there, and a bit of a fluctuating net income, but generally in the low single figures of billions of dollars. Dividend has been pretty flat for the last 10 years, as has the number of shares. So I'm struggling here to see, at least historically, how they're going to grow the shareholder value without growing the revenues or indeed dividends, or indeed doing share buybacks. Look at the cash flow, which we'll need for the valuation later. Operating cash flow translates to free cash flow. There's quite a lot of capex spending, sometimes over 50% of the operating cash flow. You're left with free cash flow that probably averages about $2.5 billion a year over the period. And just from the kind of key ratios, that return on equity is generally double figures, which is good. And the net margin seems to average around about 10% in the last 7 or 8 years. Finally, for the balance sheet, that current ratio seems to be below 1 the last 5 or 6 years, and the debt to equity above 1. So it's kind of not looking amazing. It's fine, but it certainly isn't better than many of the stocks I've got in my portfolio today. Yahoo Finance is saying not a very attractive 41 trading P, but a decent 4p of 15. Dividend forward yield 2.8, but it's a decent 5.66 as a trading yield, and 8 billion in cash as well. These are the key things to look out for. And then analysts here saying about 20% a year for the next 5 years. Impressive. Finally, simply Wall Street. So that's the pictorial form of the balance sheet. Doesn't look great. It's not terrible. It's okay. Earnings per share, look at that. 2.5 up to 8. So it's a really nice increase projected. And then 22% a year going forward. So if we plug that into valuation, use the average for the last 10 years, which the site on buffettsbooks.com calculates for you. It's very helpful. Just over 2.5 billion. Taking the midpoint between the 20 and the 22%, so 21% growth, 5 years, 10% discount rate as my desired minimum rate of return, and drop the number of shares, market price of 50, and that actually only gives an intrinsic value of 33, which is pretty low. If we have a look at the price chart, it was even 39 in the crash last year, so it's never really been this low in the last couple of years. So perhaps I'm being very conservative with my figures, maybe the discounted cash flow isn't the right method for this company. I think it is, but drop a comment below if you think otherwise. So this suggests that AstraZeneca is overvalued. So in terms of if you want a 10% a year return going forward, not the company to deliver that. Cool. So we'll now do the same assessment for Pfizer to see if that's a better bet. Okay, Pfizer. Revenue's a bit higher, but not growing. Net income seems, generally averaging about 10 billion. And the dividend has grown from 0.8 to 1.52, so it's almost doubled over about 10 years. And the number of shares to flag has dropped from just under 8 billion to 5.6 billion. So they are cranking up the dividend and buying back shares. This is how they're creating additional shareholder value. Big operating cash flow numbers, over 10 billion per year. Low capex spending, so the free cash flow must be averaging about 14 billion there. And that net margin recently always above 20%. And the return on equity looks pretty decent as well. Financial health current ratio, apart from a dip in 2019, it's always above 1. So this looks much stronger than AstraZeneca from the financials and the balance sheet. Yeah, here you go. Let's pick out that trailing P21, 4P just 12. And the dividend looks like it's 4.25%-ish, both trailing and forward, with 12 billion in cash. So this looks all right. And analysts are saying only 10% a year for the next 5 years. On Simply Wall Street, you can see here they reckon it's worth 80, so it's 55% undervalued. They reckon about 18% a year going forward. That free cash flow there, 11 billion, 20, so that's almost doubling in 5 years. Earnings per share is forecast to grow. And then, nice little dip in the debt there recently. So that looks all right. Combine all that together, we get the following valuation. 10-year average cash flow is 14.2 billion. I've taken the midpoint between 10-ish and 17%-ish. So that's 30.5% growth for the next 5 years. Discounted at 10% because that's my rate of return. And it's trading at 36.6. That gives me a value of around about 60, so 59.31. And if we do a little calculation, which is 36.6 divided by 59.31 times 100. Take 100 off that. So we've got a margin of safety of about 38%. Fairly decent. I think Pfizer is a potential buy. Peter Lynch stalwart in terms of stock categorization. I've done a video on that as well if you're interested, so I'll link that below. Decent dividend, looks undervalued, and it is better than some of the companies in my portfolio. Probably on my stalwart hit list, I would say. So it looks really interesting. And that's it for today. So I hope you found that interesting. I'd like to hear below if you own either of these companies or you believe the valuations that I've calculated are a bit off. I'm interested to hear some different opinions because it's not an exact science, this game. I'm not buying AstraZeneca, I might buy Pfizer. And that's it for today. So thanks for spending time with me and joining me. And I very much look forward to seeing you on the next one.